Hey everybody, welcome back to the podcast. I'm your host Hamza. With the end of the year coming up very quickly, dentists should be speaking with their tax advisors, kind of where their tax liability stands, and looking for other tax strategies that they can implement, with the year coming to a close. Did you know that many successful dental practice owners end up paying over 40% of their income in taxes? Now, between federal, state, local, if you even factor in payroll, property, and sales tax, that quickly adds up, right? And that's almost half your income every year kind of, disappearing basically, right? But the good news is that there's tax strategies that you can implement, right? And so we're not talking about just, the regular deductions that, you might read about online. There's some lesser known strategies for dentists that you can put into action that are easy to put into action, right? And you kind of want to use this time to go ahead and implement those, right? And so in today's episode, I want to go over our five favorite strategies for dentists and that are easy to put into action as well. That being said, I want to kind of jump into the first strategy, which is setting up a SEP IRA. So a SEP IRA is great because of the flexibility, right? And so all the contributions to a SEP IRA will be considered a business expense, which helps lower your taxable income. The big rule to know is that you want to be a long-term employee. So the owner wants to be a long-term employee, which that means you've been employed for 3 of the last 5 years and you're the only person who's been employed for that long. So you can kind of do an exclusion essentially. Now, SEP IRA guidelines is that it's up to 25% of your income. And when I say income, I mean your salary, your compensation, right? Or $69,000, whichever number is lower, right? To kind of give an example of what I mean by 25% of your salary is, let's say your W-2 salary is $120,000. So if we do 25% of that or $30,000, that gets you a $30,000 tax deduction. If we're using a 30% tax rate, that $30,000 deduction would save you $9,000 in taxes, which essentially puts that money back in your pocket. As I was kind of mentioning, the big exclusion is that you want to make sure that no other employee has worked, 3 of the last 5 years. You're the only person. There's some smaller ones, like they've earned less than $750. They're not under 21, things like that. But the big thing is the length of work. Now, the beauty of the SEP IRA is the flexibility, right? And so as long as you do the SEP IRA contribution before the tax filing deadline, you can still get a 2024 tax deduction. So, up until we file the 2024 tax return, which would be in 2025, you have that ability to do the SEP IRA. So we could be in Q1 of 2025 and still getting a tax deduction for 2024 after you look at the numbers and things like that. And so that's a great part of the SEP IRA and the flexibility. The second strategy I want to talk about is the 14-day rental, or the technical term is the Augusta Rule. So oftentimes people get, kind of confused about the Augusta Rule. They feel like it's much more complicated than it sounds. And so, essentially what the Augusta Rule is that the IRS allows you to rent your home up to 14 days and it's tax-free, right? And so kind of this strategy is kind of geared towards renting out your practice, right? Your home to your practice. Now, you want to keep this legitimate within the IRS guidelines, so you want to make your rent reasonable, right? So what would someone similar in your area rent out their home for, right? You're looking for the fair market value of renting your home out. You want to keep it simple and documented, right? And so you're having a rental rate, the terms. What was the purpose of the meeting, right? Was it a board meeting, a staff meeting, whatever, right? You're having that outlined and documented. Of course, during the rental period, solely business, right? So it should only be business activities, no personal activities during those times. And then, as I mentioned, it's called a 14-day rental. So you want to stick within 14 days. Anything past 14 days would be considered income. So the great part of that is, it's easy to implement. There's only a little bit of, documentation, things like that you want to do. But you want to make sure that you do document these things, and you obviously do your research for what is the fair market value of renting your home out, right? Again, in simpler terms, fair market value means what would someone else rent their home out for in your area, right, in your neighborhood? And you could use that as your day rate. So the second strategy that we kind of outlined is the 14-day rental, or the Augusta Rule. The third strategy I want to talk about is making your family vacations tax deductible, right? The key to this strategy is that the reason and the primary purpose of your trip is business related, right? Attending a dental conference, meeting potential vendors, right? Doing research relevant to your practice. These are things that are specific to business, and the initial reason was business. Now, the majority of your trip also has to be business. So for example, if we're traveling for a week, right? At least 4 of the 7 days are dedicated to business activities, right? So even travel days, they count as business days. You can deduct travel expenses, right? Like airfare, hotel, transportation, meals. But remember, very important, keep those receipts, right? It's very important that we keep those receipts, and you'll see the common theme here is is documentation, right? It's very important. For international trips, there's a neat 1-week rule. And essentially, if your business trip lasts a week or less, you can deduct the entire cost of transportation, even if you spend some of the time on vacation. So nice little neat rule there, for international travel. Again, using these family vacations and making them tax deductible because you're going for a dental conference or something like that. And again, majority of the trip has to be business. Please make sure you're keeping your receipts, things like that. But that's another neat way to basically turn a trip for a dental conference into a family vacation and make that tax deductible as well. The next strategy I want to talk about is hiring your kids to work in your practice, right? So by hiring your children, you can shift some of your practice's income to them, reducing their overall tax bill because obviously they're going to be in a lower tax bracket. We're assuming that they're not working. Obviously, you're in a higher tax bracket. They're in the lowest tax bracket, so it's a good way to shift income, right? Now, the wages is a business deduction. So basically, in the grand scheme of things, that lowers your practice income because you're shifting it from you in a higher tax bracket to your kids in a lower tax bracket. Now, to make this work, you need to pay them reasonable wages for the work that they're doing, right? So the work that they could be doing for your practice, admin work, marketing, social media, right? So these work that they're doing, you're just paying them for it. And again, because of the income shifting of tax brackets, that can save you taxes, right? For kids under 18, there's even an additional benefit, and basically they're exempt from Social Security and Medicare taxes if the practice is a sole proprietorship or a partnership and it's owned by the parents. So nice little neat rule there. If the parents own the company and it's either a sole prop or a partnership, you don't have to pay the Medicare and FICA taxes. So that 15% right there. So nice little additional tax benefit. And again, if your kids are helping in the practice, this is a way to get a tax deduction. As I mentioned earlier, very important to keep documentation of the hours worked, the jobs done, things like that, right? You're documenting all that stuff, and then you're paying reasonable wages. But that is our fourth strategy. Our last strategy is going to be qualifying for the qualified business income deduction, which is usually called a QBI deduction. So the QBI deduction it was introduced in the Tax Cuts and Jobs Act back in 2017, and essentially it's a kind of a free deduction if your income, your family income is between a certain threshold, right? How that works is if you're single, it's between about 190K in income to about 240. If you're married, it's about 380 to about 480, right? And so there's certain phase outs if you pass a certain income limit, but the point basically is if you are below that income range, you get a 20% QBI deduction on your business income. So if business income is $100,000, you'd get a $20,000 deduction, right? Now, for people who might be at the cusp of this deduction, right? You just have like 20, 30, 40, $50,000 more income, and you're right there. Well, these other four strategies that I mentioned, you can combine these strategies, right, to lower your taxable income, get basically into this threshold for the QBI deduction, and now you get another 20% business deduction. So what we're doing with our clients and all of the dental practice owners, what I advise is you're talking with your advisor, looking at your income situation and seeing how far am I away from the QBI deduction. Can I implement some of these strategies that we just talked about or other strategies, right, to get me into that QBI threshold so I can get that deduction? So oftentimes when we're working with our clients, we're looking at their situation, or if someone's very close, they're $20,000 off, $30,000 off, maybe we could do a SEP IRA, right? And earlier in the example, I mentioned, if you have a 120K salary and all those other criteria, you could do a $30,000 SEP IRA contribution. But now you've unlocked the QBI deduction, and that could potentially save you another 10 to 15K in taxes. And so doing these things and making these moves, kind of add on more tax savings. So it's very important, right? And so overall, the kind of recap of what I wanted to talk about is I wanted to talk about kind of 5 less common strategies, right, for dentists that we like, that are easy to implement. And as we get into the end of the year and it's time for tax filing, right, you want to be talking to your advisor, your tax advisor, and seeing what is your tax liability. What are things you can implement? Are we close to the QBI deduction, right? And could we implement some of these things to get us into that threshold? Very important is that tax planning doesn't need to be complicated, right? But it should be smart, and it should be tailored to your specific situation. As I mentioned in these other strategies, there is criteria. There is things that need to be done to be qualified. So you want to make sure it's based on your specific situation, but it doesn't need to be complicated. As always, I always recommend that, if any of these strategies intrigue you, speak with your tax advisor, all right? Let them know about the strategy, because Well, obviously we're talking high level and kind of the guidelines, but you want to talk with your tax advisor about your specific situation, right? And see, does it make sense for my situation? Because this Q4, right, as we're getting into the end of the year, is a very important time to finalize strategies, planning, right? How much do I owe? What does my tax bill look like? What can I do to reduce it? And so, our goal in today's episode was to kind of talk about 5 easy to implement strategies. But ultimately, you want to talk with your advisor and kind of go from there. But that's kind of the recap of today's episode. As always, thank you all for joining us in today's episode and look forward to the next one. Thank you.